Welcome to the Adjusted for Risk podcast, here from the shores of South Lake Tahoe. So today's episode is sponsored by the award-winning Zephyr, which helps advisors, wealth managers, financial analysts, and investment professionals make more informed investment decisions. So since Zephyr's inception some 30 years ago, Zephyr has been recognized as an industry leader in investment analytics. The status has been built on years of thought-provoking content and research, and unparalleled presentation of analytics that help investment professionals tell their story, and the creation of new analytics that help these same investment professionals tell their entire story, not just part of it. So through a series of Zephyr StatFact videos, I will help you make sense of some of these investment metrics that are used or maybe not used enough today, and how to use them. Some of you may be familiar with the Zephyr StatFacts, which was a creation or the brainchild of former Zephyr colleague Mark Odo. So I'm going to go ahead and take those fantastic resources and then put them in a video format. So there are a lot of great investment metrics out there that one can use. And in some cases, it can be a lot like alphabet soup, which can make it confusing in determining what metric or an investment professional should use. So hopefully this series of StatFact podcasts will make it easier for you and make that decision a little bit more clear when determining if you should use, the Sharpe ratio or Sortino ratio or information ratio or alpha, and exactly what they mean and what's a good number. So in this edition, I'm going to focus on a Zephyr proprietary statistic that measures the trade-off between risk and return. Risk-adjusted return statistics like Sharpe ratio, the Sortino ratio, they're very popular for numerous reasons. When these return versus risk trade-off statistics have a lot of similarities, how they differ is they differ in how they define risk, or what measure of risk they use in the calculation. For example, the Sharpe ratio uses standard deviation or a measure of volatility as the risk measure, while the Sortino ratio focuses on downside volatility. And finally, the pain ratio, which we're going to discuss today, uses the capital preservation statistic known as the Zephyr Pain Index as its measure of risk. So while they're all very similar in their risk-adjusted return metrics, it's the how they defined risk and what risk metric they use that really sets them apart. So one of the primary reasons why I like to use these risk-adjusted metrics is because they're not benchmark relative, meaning the calculations do not include a benchmark return, which allows you to compare two very different managers, or the saying goes, compare apples to oranges. Whereas statistics like alpha, trainer ratio, are relative to a benchmark, meaning you should compare similar managers in order for the comparison to be relevant. Using a statistic like pain index, though, allows you to compare, if you really wanted to, compare an equity manager to a fixed income manager to see what one provides the highest amount of return per unit of risk. Again, it allows you to compare apples to oranges, whereas benchmark relative statistics like the information ratio, alpha, there you've got to focus on using managers that are similar, maybe the same style, large growth manager against a large growth manager, a large value manager against a large value manager, and so on. So onto the pain ratio, the Zephyr Pain Ratio. It's as I mentioned, it's a proprietary return versus risk trade-off metric. The Zephyr Pain Ratio compares the added value over the risk-free rate against the Zephyr Pain Index. And now the Zephyr Pain Index measures the depth, duration, and frequency of all losses. So really, that pain ratio is a measure of added value over the risk-free rate against capital preservation, or against how a manager preserves capital. So how is it useful? While one certainly wants to minimize losses, it's also important to make money, right? You don't want to employ a manager that really has a 0% return. They want to minimize losses, but at the same time, some capital appreciation along the way. The pain ratio quantifies this trade-off into a single number. The pain ratio compares the gains over the risk-free investment against the losses that were suffered to obtain that return. Okay. So when I talk about the losses against the losses that were suffered, that's measured by the pain index. The pain index, again, measures all periods of loss. Okay, so you're not focusing on volatilities like standard deviation or downside deviation. You're focusing on all periods of loss when you're looking at the pain ratio. So what is a good number? The pain ratio is similar to the Sharpe ratio, but with a different definition of risk, like we mentioned earlier. While the Sharpe ratio measures volatility risk as standard deviation, the pain ratio uses the pain index as the key element in measuring capital preservation risk. With both ratios, as one would expect, the higher the number, the better. However, there's no hard and fast breakpoint above which one can say the ratios are good or bad, like 1% or 2%. One must compare the pain ratio of a manager to the pain ratio of its peers or an index to determine whether it is relatively better or worse than the alternatives. So really a pain index, like a Sharpe ratio, standalone, just looking at the numbers, sure, it's meaningful, but it's a lot more meaningful when you use a risk return trade-off statistic like the pain ratio against its peers. So what are the limitations? Like the Sharpe ratio or the Sortino ratio, the pain ratio can have a negative value. If the time period that you're analyzing represents a bear market, then the investment underperformed the risk-free rate. The pain ratio will be negative. If you're experiencing a bear market or any market where the performance of your manager is below that of the risk-free rate, you'll have a negative pain ratio. Therefore, one really shouldn't set hard target screens that eliminate managers with a negative pain ratio. Okay. So typical values. There's no, like I mentioned above, there's no single value that could be described as typical when understanding the pain ratio. Values for the pain ratio will be heavily influenced by the asset class in the time frame under consideration. With the pain ratio, both the numerator and the denominator will be impacted by the general market environment. So for example, in the 1980s and 1990s, excess returns were high and losses were low, leading to high pain ratios during those time periods. In the 2000s, excess returns were lower and losses were more frequent. So pain ratios were much lower. So when you're looking at pain ratios or Sharpe ratios or Sortino ratios, you have to take into context the market environment when you're looking at those. When markets and excess returns are very high, then you would expect the pain ratio to be higher, or you'd want a higher pain ratio. Conversely, like the environment that we're experiencing today, where it's a lot of negative returns, negative year to date, you'd probably expect these return versus risk trade-off metrics to be negative or very low. So when to use it? Financial advisors should consider using the pain ratio when searching for managers for clients whose investment objective is capital preservation, as the pain ratio focuses on capital preservation as its risk metric, but is not just suitable for investors concerned about preserving capital only. It is a very useful metric when you want to look at the return versus risk trade-off during periods of time when there's steep market sell-offs, corrections, or bear markets are likely. So like, for example, we're in a tough environment now where many are expecting a recession. Now is a good time when you're evaluating managers or conducting a due diligence or a review of a manager to look at their capital preservation characteristics, because there's going to be rough seas ahead. So you might want to look for managers that have good capital preservation tendencies, which will represent, better pain ratio, right? So you want to focus on a pain ratio because that helps tell the story of your manager's capital preservation tendencies with how well they perform in their excess returns as well. They're looking at the excess return or the return versus risk trade-off. So that's going to go ahead and conclude this episode of Adjusted for Risk. And I'd like to thank you all for listening and watching. You can also find other StatFact versions of Adjusted for Risk on the Adjusted for Risk YouTube channel, as well as Spotify and Apple Radio, wherever else you find your podcasts. And as always, you can always go to a wealth of insight from 6,237 feet.com to get more of my insights, as well as more information about the pain ratio, about the pain index, to help you understand how those metrics can help you better tell your story. So with that, thank you very much, and I hope you have a great rest of your week.